Mr. Deepak Sharma, Board Member, Independent Director, Suryoday Small Finance Bank, for his keynote address this evening. Please welcome him with a huge round of applause.
Hi, good evening, friends. I know after such a heavy duty panel, and I know a lot of them are my ex colleagues, I was just thinking, what should I say? Because I heard all the fancy things that you like to hear embedded finance, fintech partnership, AI, virtually everything that you can talk about, they've spoken. But I know some of you are also waiting for the awards, so I'm standing between the heavy duty panel you just had and the awards you are going to get. But I thought I'll just pick up 2 or 3 things because unlike most of the speakers here who are all still serving banker, I did a bit of my inning in banking and now I'm thinking and looking at things a little differently because 10 years at Kotak where I was involved in setting up digital, a lot of time when you are within a bank, obviously, there is a way in which you look at things. But then also you always question that why I can't do certain things the way it could be done either in an unregulated entity or by fintechs. But I think good thing today is the regulatory arbitrage is over. I think regulators have made sure that you cannot fly under the radar for too long and do some crazy things and get away in the name of calling yourself fintech. So I don't see uh, the same advantage of the fintech as a word had, say, a couple of years back versus what it has today. Uh, and if you put that level playing field to large an extent, like payment companies had to go through a payment aggregator license, account aggregator got license. If you are in lending, a lot of things on co-lending, FLDG, co-branded cards, everything got through a regulatory reset. So regulators are saying that do come in financial service, but come in a regulated manner so that the trust of consumer and the whole financial system does not get eroded just because you say, oh, I have a cool idea and I can do some crazy stuff. So I don't think the market and the regulators and the consumers prefer those hot shot, crazy people doing some crazy stuff anymore. So if you are regulated entities in the room, uh, I must tell you, there is a lot of opportunity for you to keep incrementally transforming, changing, becoming better. If you are an unregulated entity, obviously you are thinking already either you get NBFC license, RIA license, you get some kind of regulatory credibility so that you have a right to play this game in long term. Having said that, I think if you are selling to any of the financial service providers, that's the third angle because then you're a technology company, you have a great solution, and you find at times the financial service providers are slow to respond, or you really do not know how to get the best decision or faster decision out of them. So these are 3 typical communities I end up meeting: banks or regulated entities, startups, and the technology companies who are offering their solution to financial services industry. Now, if you look at all these 3 different dimensions put together, I think where is the opportunity to grow? Because if all of us end up doing the same thing, then what differentiates us? It's cost of capital if you are in lending business, your risk management, your collections, your cost of origination. At the end of it, what else can you go and do differently unless you want to go and do a subprime lending, you are going and picking up affordable housing as a segment, or you want to go and do a microfinance and or probably build certain high risk business. But even that in today's scenario is less likely to happen because regulators do not want lenders to have a high unsecured exposure in their portfolio. They want to make sure there is a tighter balance between the consumer credit versus the credit to SMEs and business. And thereby there is a greater trust. to create more access to credit on a secured lending or to SMEs and business. Classic example is a Uber driver. As a bank, you can give him a loan to buy a washing machine, or you give him a loan to buy a car. Finally, there are two credits going to the same individual, but the purpose for which a credit is given is very different. I think the way the whole ecosystem today, right from government to regulators, are looking at it is provide him credit to buy a car and not a washing machine. Consumption-led credit growth is going to slow down, while the credit that is used for generating revenue, for creating employment, for business is where you will see a lot of growth happening. So thereby, if you are thinking about a risk scoring model, if you are thinking of your product and tech, start looking at the kind of complex workflows which a secured lending would require. The way the collection on a secured lending will happen, the way the whole underwriting and credit engine will move. So as you start understanding where the consumer demands are shifting, what the regulators and government are pushing, and how the regulated entities are changing their business mix, there would be a set of new opportunities that will emerge. Classic cases, I was instrumental in driving one of the first cash flow-based lending product in the country on a platform called Ocen, OCEN. You would have heard of it. There were not many lenders who jumped in because on a government marketplace, typically if you are selling it to any of the government or public institution, you can get invoice discounting, which is a 90-day kind of a discount period. You can provide access to credit because you do know that the government will not default on the payment, and thereby you don't have a risk, and thereby it gives a kind of a working capital cycle to the institution or small businesses who supply to this government. Same opportunity today exists beyond what a government marketplace can provide. For example, if you want to make your credit accessible to a restaurant, who has a better data on the restaurant than a Zomato and a Swiggy? Because what is their turnover, what is their rating, what are the kind of pricing, what is their average ticket size, who are the kind of supplier credit. Now, you may get a GST data, you may do financial underwriting, but that will give you 80-90% comfort any which way. But if you have to think ahead in this market, I think data is unlocking a lot of potential for credit underwriting. So I think when you look at credit as a space, in my mind, that is one place that will continue to get disrupted because a country like ours growing at 7-8% will continuously have a credit growth of anywhere between 22 to 25% or more. And this growth will continue for next 10, 15, 20 years because that's the only way you will create access to capital for growth. And every financial institution, irrespective of its size, NBFC, banks, small finance banks, public sector banks, they all have this one single thing that how do we improve the quality of credit, build growth. So I think thinking credit, reimagining credit from technology lens, from the risk lens, from underwriting, building better BRE solutions, which is bringing in the second party and third party data, building the real-time cash flow-based lending models, and through account aggregator now, and ULI, even your ability to monitor the utilization of credit and thereby have a better quality of credit and collection can go through a transformation. So I think that is one fundamental shift I'm seeing. The other change that will drive the transformation in a big way is the whole credit moving on the railroad of UPI. When I talk to a lot of CEOs, CIOs, I think people still ask this question, do you think credit on UPI indeed will become big? My question is same, that did any one of us 7 years back thought UPI will become as big? A lot of times, if you cannot visualize how things will change, we all start with a disbelief. UPI is no more what you do on a Google Pay and a Phone Pay. I don't know if some of you read recently when the Bajaj housing IPO came, a lot of customers could not get their allotment because the UPI mandate failed, 10% failure. Now think of if you are one of those investors and when you saw the opening day more than 100% up, I mean, you will curse. But was it making a P2P payment, P2M payment? Answer is no. So UPI has started to become a railroad on which you will have a goods train and a Vande Bharat both going. It's an infrastructure layer on which whatever you want to ride will ride. A OD will ride, a collection will ride, a IPO will ride, a mandate, a standing instruction, any form of credit. And it's not just retail credit. Similarly, today, NBFCs are not able to get the full, I would say, benefit of what a UPI can do for them. But gradually, this will open up for NBFCs too. And I strongly believe that the market is going to explode by reimagining the whole credit stack. Today, banks or NBFCs had built a separate stack, be it for a personal loan or a credit card or a home loan or a LAP, because these businesses were built over last 20, 30 years. And every time you built a business, you had to go and look for a pointed solution that can solve that problem well. Not anymore, because I think the way things are changing, both the core banking and the credit stack, but credit stack before core banking. Core banking still we believe is extremely difficult to replace. So you have a set of plugins that are coming in, but the credit stack is going through a massive transformation. I'm involved in helping and shaping some of the work that's happening largely on reimagining credit for India, because that in my mind can unlock opportunity for access to credit for small businesses or even people who need a daily cash flow based lending and access. And all that can only be provided through a railroad like UPI. You just do not have any other way in which a credit can ride both disbursement of credit, monitoring of credit utilization, and collection of money. So all the three aspects are extremely important. I think the last, mindful of the time, I'll just take one more because there are many ideas, but I just thought I'll focus on credit for today. And the second I would call it is on leveraging truly the capability of what a Gen AI can do for the firm. I know, like any technology, it goes through hype cycle. Every few years, we pick up one technology and then we spend a lot of time talking about, be it a metaverse or probably looking at Web 3.0, blockchain. Even though my friend Prasanna, he's the only guy I've seen who has actually converted something out of blockchain, but I haven't seen too many other success stories on blockchain beyond Blockstack. But I think on AI and now moving to Gen AI, there are some real values because the hype cycle is settling down. I think that's the good thing. I always keep saying when everybody is riding, it's better you stay off the road and see how the traffic is, and then decide when do you want to start. It's the same thing on any new technology wave. But I think there are a couple of use cases which I've started to see is definitely bringing in the ROI, because there is a greater clarity on the deployment structure, on the security, whether the data that you are using as a training data, whether your data moves out of the organization, so from privacy and security, from the biases, how these gets managed. And largely wherever you have volume of unstructured data is the number one place to get started from. So a lot of times people do ask me, where do we get started? Because there are multiple use cases and you talk to someone who's selling a solution, they will just create promise. No offense to them, they are doing their job. But I think as an institution, important to see where do you get a better ROI for implementing a use case. And I have seen the biggest value or the benefit globally now organizations have started to see is again between the credit lending operations. So back to wherever you have voluminous data, you have to take a decision, you have to standardize your credit making decision, or operation has to create the kind of query coming from multiple documents. While things like chatbots and all are good to do, I am not demeaning it. You can keep experimenting with, there are hundreds of applications. But if you have to start thinking of one place to get started, It's at the back end and it's not in the front. AI is not a standalone, shiny gizmo. AI is getting more and more embedded in what you do every day. So thank you very much for inviting me over. Thank you.